Welcome to the Daily Trader. I'm Tom White, filling in for Kevin Hinks today. We've got a couple of big names to talk about. We're going to walk through some option strategies and some names that you might recognize. We're going to take a look at Palantir, which is up 350% this year, leading the S&P 500. And then we're also going to take a look at an option trade in Apple, which is up about 30% this year, just off of all-time highs, also as valuations rise. So let's walk through a couple of these option strategies. I'm going to give you the reasoning behind them, what expectations are, what your risk, what your potential reward are on these positions, and how to potentially manage them as we get into the trades. Let's start it off with Palantir, as I mentioned, up about 350% so far in 2024 as we're getting close to the end of the year. Saw some profit taking over the last couple sessions here, down about 4% on Friday, down about 2% in today's session. But like I said, profit taking on a stock that's been up 350% on the year, maybe not a bad thing. You take a look at the chart here. Far above its moving averages. You look at those volume nodes on the right there. Most of the volume is to the downside, as this stock has been the AI darling as they move more into from the government side of their business into the commercial side of their business. They've had 5 straight quarters of revenue growth, margin expansion. Alex Karp, the CEO, pretty charismatic also during those. But valuation's getting really stretched at this point. But like I said, we've seen a little bit of a pullback here going into the end of the year. So the strategy I looked at, I want to avoid earnings. Earnings are in early February, on the 3rd of February. So I'm going to avoid that. You should always check the Thinkorswim trading platform for when earnings are. Those little bubbles there at the bottom of the chart there kind of give you that indication on when confirmed earnings are. So we're going to avoid earnings. We're going to go out to the January 31st weekly cycle. So these will expire. These options will expire before earnings. What happens in earnings? Well, anything can happen. It's event risk, so I want to avoid that. But take advantage of the pullback that we've seen in the stock. So the stock currently trading around $77 a share. So I looked at a simple call vertical. It's not simple. It's one of the more basic option strategies where I'm going to buy something that's at the money or slightly in the money. In this case, I'm going to buy the January 31st weekly cycle, the 76 strike call. And then against it, because I want to offset some of the risks. When you buy that call and implied volatility levels are elevated, you're going to have a lot of extrinsic option premium in those. So I want to kind of offset that. So against that long 76 strike call I buy, I'm going to sell that 86 strike call that's $10 above that 76 strike. So it's a bullish $10 wide call vertical to the upside in the January 31st weekly cycle. So 32 days to expiration on this one. You're paying roughly about a $4 debit for a $10 wide bullish call vertical. What does that mean? Well, my break even is that $4 I paid for the call vertical added on to the long call in this position, which is the 76. So that means my break even where I experience profitability is above $80 a share. You're paying $4, less than half the width of this $10 wide vertical. So that risk reward profile is I'm risking $400 per spread to make a potential $600 on this position if it goes above 86 into expiration over the next month on this one. Now, with buying verticals like this, I always kind of like to get into a little bit of trade management. If you're long this vertical, you paid $4 for it, maybe before expiration in 32 days, it goes up to maybe 81, 82, and the price of this vertical expands to maybe $6 or $7. The flexibility of long verticals like this one allows you to potentially close or adjust this position prior to expiration. So it gives you that flexibility where, hey, if the stock does go to 82, 83 before expiration, and this thing expands, maybe it goes to $6, $7, $8, it allows you to maybe close a portion of your position if you did multiple contracts on this type of trade, or close all of it. If you want ahead of time, take your profit and move on to the next position. That break even of $80, only about $3 above the current share price. So you don't need a monster percentage move. Now, 86, if it has to go up to 86 for you to realize that max profit at expiration, where this vertical spread would expand to $10. But at the same time, you've given yourself some duration on this position while avoiding that earnings event on the 3rd of February. So if you think the stock's going to rise into those results, hit new all-time highs, 86 would be a new all-time high, the all-time high just below 85 that we hit in early December. So take that into consideration also. So this is the type of strategy that you can use where you can offset some of your costs by selling the 86 call against your bullish long 76 strike call. So one of the more basic option strategies to take a directional bias while offsetting some of your risk on this type of bullish position. So that's the Palantir trade, bullish to the upside. Now let's get into a discussion about our next stock. That's going to be Apple. This stock has been rocketing to the upside, just below all-time highs. We've had some weakness the last couple of days in Apple, but we wanted to talk about this one because valuations are getting stretched in this one. You see the chart here. It's one of the Mag 7 names. It's in 3 of the 4 major indices in the Dow, in the S&P 500, and the NASDAQ 100. So take that into consideration. It's a big weighting in those, and we've seen strong gains in this. And this is on the back of what? iPhone 16 release, right? Artificial intelligence, Apple Intelligence, which are starting to slowly roll out with each new iOS release. They're up to 18.2 right now, but we haven't seen the bigger ones. But this is all based, the moves are based on optimism that AI is going to be, right in Apple's wheelhouse. They're going to be able to expand and monetize AI within their product and environment ecosystem base that Apple has, and the upgrade cycle for the iPhone 16 because the Apple Intelligence only works on the 15 and 16 Pro models. And there was a note out today from BTIG, Jonathan Krinsky. He's a technical analyst, and he's saying it's getting a little bit heavy here. They've got earnings at the end of January, so this is going to be another strategy I'm going to look at that's bearish. But it avoids that earnings event because maybe we are getting stretched on valuations with a PE ratio above 40. Historically, that's below 25. But there's a lot of hype around Apple. So I looked at a bearish strategy. I went out to the January 17th monthly cycle. So about 18 days to expiration is really short-term positioning if you think maybe we're due for a pullback, or if you own the shares and you maybe want to protect some of those gains. This type of strategy takes advantage if the stock does pull back and it starts to expand in price. So I looked at an unbalanced or broken wing put butterfly in Apple, where I'm going to buy something that's at the money. One time, I'm going to buy the January 17th 252.5 strike put. I'm going to sell 2 of the 245 strike puts, and then buy 1 of the 242.5 strike put. So it's unbalanced in the regard that I'm buying the 252.5, 245 put vertical, offsetting some of the cost by selling the 245, 242.5 put vertical to offset some of those costs, and that lowers your risk on this type of position. You can see here from the risk profile, if I'm paying a debit of around $2, that's my risk, $200 per spread. The apex of profitability, you can see here from the risk profile, is at or near that short 245 strike that you have short 2 options on. So buying 1 252.5, selling 2 245s, buying 1 242.5 puts. That creates this unbalanced put butterfly. The debit you pay is your risk on this one. Your break even is $250.50. So you don't need a massive move to the downside to get into that profitability thing. Now, you look at this setup and you go, well, even if it goes below 245, I start losing some of my profitability, and that levels out. But it's still more than a double in profitability because you're buying a $7.50 wide put vertical, and or you're buying a $7.50 wide bearish put vertical, offset by selling a $2.50 wide put vertical to offset some of the costs. That's why the price is so low on this one, but it's still more than a double in profitability if this stock goes below 242.5 into expiration over the next 2.5 weeks. So that's the way you look at this one. When you're doing a put butterfly that's unbalanced or a broken wing put butterfly, is that, hey, you don't expect it to maybe explode to the downside or in the event that you're doing a call butterfly, explode to the upside, but you think it's going to maybe gradually give up some of those gains. Maybe there's some profit taking there, or maybe a hedge on a long stock position. A lot of people have Apple in their portfolios, whether they know it or not, either the stock individually or within some of the indexes and ETFs. So take that into consideration also. But this is a bearish stance on Apple, expecting some maybe grind lower down to at or near that 245 level. We're getting extended on some technical basis here in Apple, despite the pullback that we've seen for the last couple of sessions. So take that into consideration. But the stock's still up 30% this year. But if you're bearish, this is a strategy that takes advantage of that over the next couple of weeks. So take that into consideration. All right, that's going to wrap up the Daily Trader today. I'm Tom White. Make sure you watch the Schwab Network all day and download the app.